You know, I get this question all the time, Warren. People come up to me and ask, how much do I need to save to retire? And I always tell them, well, it depends. It really depends on a whole bunch of different factors. But then they always follow up with another question. They'll say, okay, but what if I want to retire in, say, 10 years? How much would I need to invest every single month? And you know what? That's actually a much better question because it's super specific. Now, I'm currently 94 years old, and I've never really actually retired, and honestly, I probably never will. But I've watched thousands of people go through retirement, some with great success, and some, well, not so much. And through all that, I've learned a thing or two. Retirement isn't really about hitting some magical number and then just stopping all work. No, it's about having enough money socked away so you don't have times to work if you just don't want to. That's true freedom, right there. That's what we're really talking about here. So, today, what I want to do is walk you through the real math, the nitty-gritty numbers. I'm not talking about some fantasy where you're sipping margaritas on a beach somewhere. I want to give you the actual numbers for someone who is seriously looking to achieve real financial independence in 10 years. So let's start with the big question, the most important one of all. How much money do you actually need to retire? The answer, plain and simple, is that it depends on how much you spend. You see, most people tend to think about retirement completely backwards. They're thinking, oh, I need $1 million, or I definitely need $2 million. But that's just not how it works. The real question isn't how much you times need asterisk. The real question is how much you times spend asterisk. Your retirement number is always going to be based on your spending habits, not just some random, arbitrary target. Here's a good rule of thumb, something called the 4% rule. It basically says that you can safely withdraw 4% of your investment portfolio each year without having to worry about running out of money. So if you spend, say, $40,000 a year, then you're going to need $1 million, because 4% of $1 million is, of course, 40,000. And if you spend $80,000 a year, you're going to need $2 million. But if you only spend $20,000, then you're looking at needing only about $500,000. See how that works? Your spending is what determines that final number. Now, the 4% rule, it's not perfect. It makes a few assumptions. It assumes you're getting a certain return on your investments, about 7%, after you account for inflation. It also assumes that you have a pretty balanced portfolio, stocks and bonds. And it assumes that you're probably going to live about 30 years or so in retirement. So if you're retiring around 65 and you're probably going to live to be about 95, the 4% rule is likely going to work just fine. But if you're retiring earlier, like at 50, and you think you might live to 90, then you probably want to be a little more conservative, maybe shoot for 3.5%. And if you're thinking about retiring at 40, maybe even go for 3%. The earlier you retire, the more conservative you're going to need to be because you need your money to last you a whole lot longer. Okay, so let's do some quick math. Let's say you want to spend $50,000 a year once you retire. That's a pretty reasonable middle-class lifestyle for most places here in America. So using that 4% rule, you'd need $1.25 million. Because, again, 4% of 1.25 million is 50,000. So that's your target. $1.25 million. That's your retirement number. Now, the big question becomes, how exactly do you get there in just 10 years? You see, this is where things get really interesting. In order to reach that 1.25 million mark in 10 years, you need to know a couple of key things. First, how much money do you actually have saved up already? And second, what kind of return are you likely to get on your investments? So let's start with that second question, returns. Now, I can't predict what's going to happen in the future. Nobody can. But if you look at history, the stock market has generally returned about 10% per year. Some years it's higher, some years it's lower, but on average, it's been around 10%. So we can use that as our working assumption, 10% per year. Now, that's definitely optimistic. That assumes you're putting all your money into stocks and that the next 10 years are going to be pretty average. But it's still reasonable enough for us to use for planning purposes. Okay, so let me give you a few different scenarios here, with different starting points and the different amounts you'd need to invest each month. Let's start with scenario number 1. You're starting from absolute zero. You haven't saved a single dime yet. In order to reach 1.25 million in 10 years with that 10% return, you'd need to invest about $6,500 every month. Now, that's a lot of money. That's $78,000 a year. Most people just can't do that unless they're making a pretty high income and are living way below their means. All right, scenario number 2. You've already got $100,000 saved up. Now, you only need to reach 1.15 million with your new investments. Again, at a 10% return, you'd need to invest about $5,000 per month. That comes out to $60,000 a year. Still a lot of money, but a little more doable if you're seriously committed to it. And then scenario number 3, you've already got $250,000 saved. Now, the math starts to look a whole lot better. Because that $250,000 is going to grow all on its own at that 10% rate. After 10 years, it's going to become about $650,000. So now you only need to save another $600,000 with your monthly investments. And to do that, you'd need to invest about $3,000 per month, which is $36,000 a year. That's starting to look a whole lot more realistic for many folks. You see, the more you already have saved, the less you need to invest each month. That's because the money you've already saved is compounding, it's growing, it's working for you. And that's the real power of starting early. That's the power of compound interest. If you start saving in your 30 seconds, by the time you're 40, you've got a big head start. But if you wait until you're 40 to start, you're basically starting from scratch, and the numbers get really tough. Okay, let me talk about something really important here, the assumptions we're making. That 10% return? That's a big assumption. Some years, the market goes up 20%. Some years, it goes down 20%. And if you happen to retire right after a big down year, right after a crash, you might be in some serious trouble. That's because you're taking money out of a portfolio that's already been depleted, and it might not recover quickly enough. This is what's called sequence of returns risk, and it's one of the biggest risks you face if you retire early. So, what can you do about it? Well, you build in a margin of safety. You plan for lower returns, maybe shoot for 7 or 8% instead of 10. Or you could just save more than you think you're going to need. That way, if things go wrong, you've got a cushion, or you stay flexible. If the market crashes right when you're trying to retire, consider working another year or two. That's what I would definitely recommend, flexibility. Don't lock yourself into some super rigid plan. Have a target in mind, but be willing to adjust that target based on what's actually happening in the real world. Okay, so let's talk about the other side of the equation here, spending. Because here's the thing. The less you spend, the less you need to save. And the less you need to save, the easier it becomes to retire early. If you can find a way to live on $30,000 a year instead of $50,000, you only need $750,000 instead of $1.25 million. That's a huge difference. That's $500,000 less you need to save. And if you can manage to live on just $20,000 a year, then you only need $500,000. Now, I know what you're probably thinking, Warren, there's just no way I can live on $20,000 a year. And maybe you can't. Maybe you just need more than that. But a lot of people could probably live on a whole lot less than they currently think, especially if they're strategic about it. If you move to an area with a lower cost of living, if you learn to live a simpler life. You see, there are really two primary ways to retire early. You can earn more money and save more money, or you can spend less money and therefore need times less money. Most people just focus on that first one. They think, oh, I just need to make more money. But that second option is often a whole lot easier and a whole lot more powerful. Because if you can cut your spending by just 20%, you're going to need 20% less to retire. Asterisk in times, you'll be able to save 20% more. Because you're spending less, so it's like a double benefit. You need less, and you save more. That's the real magic of living below your means. Okay, let me give you a slightly different example here. A more aggressive scenario for someone who really, truly wants to retire in 10 years. Let's say you're 35 years old. You're making $80,000 a year, and you're dead serious about retiring at 45. Here's what you'd need to do. First, you'd cut your spending down to the absolute bone. Let's say you manage to live on just $30,000 a year. That's not going to be easy, but it's definitely doable, especially if you're really motivated. That means you'd be able to save $50,000 a year out of your $80,000 income. That's a 62% savings rate, which is extremely high, but still possible. Now, at that 62% savings rate and only needing to live on $30,000 a year, you'd only need $750,000 to retire using that 4% rule. That's because 4% of 750 is 30,000. So the question really becomes, can you actually get to 750,000 inches 10 years? Well, if you're saving $50,000 a year and you're getting a 10% return, after 10 years, you'd have about 800,000. So, yes, you can do it. You'd hit your target and you could retire at 45. Now, would I actually recommend this? Would I tell someone to do this? Maybe if they're truly committed and they really understand all the inherent risks. But it's definitely aggressive, really aggressive. It assumes you're going to get high returns, you're going to have very low spending, no major emergencies, and it doesn't really leave much room for error. If the market crashes right when you're trying to retire, you might just have to wait. Okay, let me talk about something else here, Social Security. Because when most people are thinking about retirement, they often forget all about Social Security, and that's a mistake because Social Security can make a really significant difference. The average Social Security benefit is about $1,800 a month, which works out to around $21,000 a year. Now, if you retire really early, before you're 62, you won't be able to get Social Security right away. But once you hit 62, you can start claiming it. And that $21,000 a year will really reduce how much you need to take out of your portfolio. So, instead of needing to withdraw $50,000 a year, you only need to withdraw $29,000, which means you're going to need a smaller portfolio, maybe $750,000 instead of $1.25 million. That's a huge difference. And it really makes early retirement a whole lot more achievable. You see, when I think about retirement planning, I always think about it in layers. Layer number one is Social Security. That's your base, your foundation. It's guaranteed income for the rest of your life. Layer number 2 is your portfolio, your savings, and your investments. That's what you're building up during all those working years. And then layer number 3 is flexibility. The ability to adjust things, to work part-time if you need to cut back on spending if the market happens to crash. That flexibility is what gives you real security. That's what lets you retire early without having to take crazy risks. Okay, so let's talk about something really practical here, where to actually invest this money, this monthly amount that you're saving. Because it's just not enough to simply save money. You've got to invest it too. You've got to put it to work for you. Let it grow. And times you invest that money is going to determine what kind of returns you get. And those returns are what ultimately determine whether or not you actually hit your target. Now, I've always been a big stock investor. I'm a believer in equities, ownership, and actual businesses. Because over the long haul, stocks outperform basically everything else out there. Bonds, cash, real estate, you name it. The stock market has generally returned about 10% per year for the last 100 years. Some decades it's higher, some decades it's lower, but on average, it's been right around 10%. And if you're only saving for 10 years and trying to build wealth pretty quickly, you really need those returns. You're just not going to get there with bonds. Bonds might only return 4 or 5%. That's just not enough to help you reach your goals in 10 years. You really need stocks. You need to have equity exposure. Now, what stocks should you buy? Well, if you're a really sophisticated investor, if you truly understand businesses, and you can read financial statements, you could try to pick individual stocks, find some great companies at good prices, and build a portfolio of maybe 10 or 15 holdings. That's what I do. That's what I've always done. But most people just can't do that. They just don't have either the time or the knowledge required. And that's perfectly fine. That's exactly what index funds are for. You see, an index fund just owns everything. The S&P 500 index fund owns the 500 largest companies right here in America. You get Apple and Microsoft and Google and Coca-Cola and Johnson & Johnson and basically everything else all in one single fund, and it costs you basically nothing. And historically, the S&P 500 has returned about 10% per year. Some years, it's up 30%. Some years, it's down 20%. But on average, over long periods, it's been right around 10%. And that's what you need. That's what's going to get you to your ultimate retirement goal. So if I were in your shoes, if I was starting from scratch and trying to build wealth for retirement, here's what I'd do. I'd open a retirement account, either an IRA or a 401k, and every single month I'd invest in a low-cost S&P 500 index fund automatically like clockwork. $3,000 a month or $5,000 or whatever amount you've calculated that you actually need. And I'd do that every single month for 10 years. Rain or shine, bull market or bear market, doesn't matter. Just keep investing, keep buying, keep accumulating those shares. You know, this strategy actually has a name, dollar cost averaging, and it's a really powerful strategy. It really is. Because when you invest the same exact amount every month, you naturally buy more shares when the price is low and fewer shares when the price is high. Over time, it all averages out and you end up with a pretty good average price, and you don't have to worry about trying to time the market, trying to figure out exactly when to buy and exactly when to sell. You just buy every month, consistently. That's the whole strategy. That's how you build real wealth for retirement. Okay, let me talk about taxes now, because taxes really matter. They really, really matter. If you're investing in a taxable account, you're going to be paying taxes on dividends and capital gains every single year. And all those taxes are going to eat into your returns. They're going to slow down your compounding. But if you're investing in a retirement account, like a 401k or an IRA, you don't pay those taxes until you actually withdraw the money, which means all your gains are going to compound tax-free for years, for decades. That's a huge advantage. It can really add hundreds of thousands of dollars to your final balance. Let me just show you the actual difference here. Let's say you invest $5,000 a month for 10 years at a 10% return. In a taxable account, after paying those taxes each year, you might end up with around $900,000. But in a retirement account where you don't pay taxes until you withdraw the money, you could end up with well over $1 million. That's a $100,000 difference just from that tax deferral. So, use those retirement accounts. Max them out. Do the 401k first, because a lot of employers will actually match your contributions. That's literally free money. Then do an IRA, then a Roth IRA if you qualify. Get as much money as you can into those tax-advantaged accounts. That's how you maximize your overall returns. Okay, let me address something that a lot of people are always concerned about. They come to me and say, "Warren, what if the market crashes? What if I'm halfway to my goal and the market just drops 40%? And that's a really valid concern, because markets really do crash. They crash regularly, about every 7 to 10 years. There's a major crash, a bear market, a recession. It happened back in 2000, in 2008, and again in 2020. And it's going to happen again, probably sometime in the next 10 years. So if you're on this 10-year retirement plan, you're almost certainly going to experience a crash. The question is, what do you actually do about it? You see, there are two fundamentally different ways to think about a crash. Most people think of it as a total disaster, a complete catastrophe. They panic. They sell everything. They lock in all their losses. But that's exactly the wrong thing to do. That's the absolute worst thing you can do. A crash, if you're still in the accumulation phase, if you're still saving and investing, is actually an opportunity. It's a gift. Because when the market's down 40%, everything is on sale. Stocks that were previously too expensive are now cheap, and you're still investing every month. You're still buying. So you're buying at these super low prices, accumulating even more shares for the same amount of money. And when the market eventually recovers, and it always recovers, those shares that you bought on the cheap are suddenly worth a whole lot more. So don't fear those crashes. Embrace them. As long as you're still working and still saving, a crash is your friend. It's an opportunity to buy low. Now, there is one major exception to this, of course. If you're retiring really soon, like in the next year or two, a crash can definitely be a problem. That's because you're about to start withdrawing money. And if your portfolio is down 40%, you're going to be withdrawing money from a portfolio that's already been severely depleted, and that can be dangerous. That's why, as you get closer to retirement, you should probably shift some of your money out of stocks and into bonds. Not all of it, of course, but some, maybe 20 or 30%. Bonds are a whole lot more stable. They don't crash like stocks do. So they're going to provide you with a cushion, a buffer. And if the market crashes right when you retire, you can live off those bonds for a year or two while you patiently wait for the stocks to recover. That's the whole strategy. That's how you manage the risk. Okay, let me talk about something else now, healthcare. Because if you're thinking about retiring early, before you're eligible for Medicare, healthcare is a really big issue. Medicare doesn't start until you're 65. So if you're retiring at 55 or 50 or even 45, you've got a gap, a period where you still need to have health insurance. And it's going to be expensive, really expensive. Private health insurance for a couple can easily run you $1,000 or $2,000 a month. That's $12,000 to $24,000 a year just for health care. So you definitely need to budget for that. You need to include it in your overall retirement spending. If you thought you'd only need $50,000 a year and then you realize you need another $20,000 for health care, now you actually need $70,000, which means you're going to need a bigger portfolio, maybe $1.75 million instead of $1.25 million. That's a big, big difference. And a lot of people just don't think about this. They get to retirement and they're completely surprised. Don't be surprised. Plan for it. You see, early retirement isn't just about having enough money to live on. It's about having enough money to cover all of your expenses: healthcare, taxes, insurance, emergencies, and you definitely need to have a cushion, a margin of safety, because things are definitely going to go wrong. Cars break down, roofs leak, people get sick. If you've planned everything perfectly with absolutely no margin for error, you're almost guaranteed to run into trouble sooner or later. So, be conservative. Build in a buffer. Save more than you think you're going to need. Spend less than you think you actually can. That's how you make early retirement actually work. Okay, let me tell you about a friend of mine. He retired at 55, about 10 years ago now. And he did basically everything right. He saved aggressively, invested in index funds, and built up a pretty decent portfolio of about $1 million. He calculated that he'd need $40,000 a year, and 4% of $1 million is $40,000. So he thought he was completely set. And for the first few years, it worked great. The market was going up, and his portfolio was steadily growing. Even as he withdrew money, he was living the absolute dream, traveling, playing golf, spending time with his grandkids. But then 2022 happened. The market dropped like 25%, and suddenly his $1 million portfolio was worth just $750,000, and he was still withdrawing $40,000 a year. But now, that's a whole lot more than 4%. It's actually over 5%, and at that rate, he's going to run out of money eventually. So, you know what he did? He went back to work part-time, just a little bit of consulting work, not because he actually wanted to, but because he just had to, because his original plan didn't actually have enough of a margin of safety built in. Now, this isn't a complete tragedy, of course. He's still better off than if he'd never retired in the first place. And the part-time work really isn't all that terrible. It gives him something to do. But my main point here is that if he'd just been a little more conservative, if he'd saved a little bit more or waited a few more years, he wouldn't have needed to go back to work at all. He'd have real freedom. That's why a margin of safety really matters. That's why you need to be super conservative with your planning. Okay, let me give you my own personal recommendation. My honest recommendation for someone who wants to retire in 10 years. First, figure out your spending, your times, real-time spending. Not what you think at times should times be, but what it actually times is asterisk. Track every single dollar for at least a few months. See exactly where it's all going. Then multiply that by 25. That's going to be your target retirement number using that 4% rule. So if you spend $50,000 a year, you're going to need $1.25 million. Now, take a look at how much you already have saved and figure out how much that's likely to grow to in 10 years at a reasonable rate of return. let's say 7 or 8%. Be conservative. Then figure out the gap, the difference between what you'll actually have and what you really need. And then divide that by 120, which is the number of months in 10 years. That's how much you're going to need to save each month. And if that number is just impossible, if you simply can't save that much, then you really only have 3 primary options. You can work longer than 10 years, you can somehow spend less in retirement, or you can try to earn more money now so you can save even more. Those are really your only options. So, pick one. You see, retirement planning really isn't magic. It's just simple math. Really simple math, but it's honest math. And a lot of people just don't want to do that honest math. They want to believe that they can retire on less than they actually need. They want to believe that the market will always go up and that they'll never have any kinds of emergencies and that healthcare won't cost all that much. But that's just wishful thinking. That's really not planning. Real planning is conservative. It assumes that things aren't going to be perfect. It builds in all those buffers, that margin of safety. And if you do that, if you're honest and you're conservative, you really can retire early and successfully. But if you're overly optimistic, you're just setting yourself up for a big disappointment. Okay, let me talk about just one more thing here. The psychology of retirement. Because having enough money is really only half the battle. The other half is really knowing what your retiring times to asterisk. A lot of people just think that retirement is simply not working, but that's really not enough. You need to have something to actually times do asterisk, some purpose, some structure to your days. I've seen plenty of people retire with a ton of money, and they're absolutely miserable because they're just plain bored. They feel completely useless. So before you actually retire, really think hard about what you're going to do with your time. What about hobbies? Volunteer work? Maybe some part-time work that you actually enjoy? Travel? Learning something new? You need something to fill that void. Otherwise, retirement is just going to be emptiness. You know, that's one of the primary reasons I've never really retired myself. I just love what I do. I absolutely love investing. I love running Berkshire. I love working with people I really respect. So why would I ever want to stop? Money really isn't the reason I work. I've got more money than I could ever possibly spend. I work because it gives my life real meaning, real purpose. And I think a lot of people would be a whole lot happier if they actually thought that way. Not how fast can I retire, but how can I find work that I truly love, that I'd really want to do even if I didn't need the money. Because if you truly love what you do, retirement just becomes less important. You might still want financial independence, the ability to quit if things ever change, but you're not going to be counting down the days. You're not going to be desperate to escape. You're just living your life, doing work you actually enjoy, and building wealth as a byproduct of that. Well, I suppose I should probably wrap this up now. So, how much do you actually need to invest every month in order to retire in 10 years? The answer, again, is that it depends on how much you already have, on how much you actually need to spend, and on what kind of returns you end up getting. But as a very rough guide, if you're starting from absolute zero and you want to spend $50,000 a year, you're probably going to need to invest somewhere between $5,000 and $7,000 a month. That's a lot of money. That's $60,000 to $84,000 a year. Most people just can't do that unless they're making a really high income and living a very frugal lifestyle. But if you've already got some money saved, if you've got $100,000 or $200,000 already socked away, the numbers start to get a whole lot easier. You'd need around $3,000 or $4,000 a month. And if you're prepared to live more frugally in retirement, perhaps living on $30,000 or $40,000 instead of $50,000, the calculations become even simpler. You might only require $2,000 or $3,000 each month. The critical thing to remember is flexibility. If you are too rigid, if you insist, I absolutely must retire in precisely 10 years, and I absolutely must spend this specific amount, you could be setting yourself up for disappointment because life just isn't that predictable. However, if you're adaptable and think, I would like to retire in 10 years, but I'll make adjustments depending on how things unfold, then you have a significantly greater chance of success because you can adapt to changing circumstances. You can react to reality. Perhaps the market performs exceptionally well and you retire in 9 years, or perhaps the market crashes and you postpone it until year 12. Either way, you'll be fine because you're flexible. Okay, here's my advice to a young person, someone in their 30s or 40s, contemplating early retirement. Start right now, today. Begin saving. Begin investing. Even if you can't save enough to retire in 10 years, even if the numbers don't quite add up yet, every dollar you save now compounds. It grows. It provides you with more options down the road. And the consistent habit of living below your means and investing regularly, that's the most valuable thing, more valuable than any investment return you might get. Because if you establish that habit, if you automate it, you'll eventually achieve financial independence. Maybe not in 10 years, perhaps in 15 or 20, but you'll get there eventually. And when you do, you'll have freedom. You see, financial independence isn't truly about retirement in the strictest sense. It's about having options. It's about not being compelled to do things you don't want to do. You might use that independence to retire completely, to stop working altogether. Or maybe you use it to change careers, to start your own business, to work part-time, or even to take a year off to travel the world. The important thing is that you have choices. You're not trapped by needing a regular paycheck to survive. That's genuine freedom. That's what we're really striving for. Well, I'm 94 years old now, and I've been financially independent since my 30s, probably even earlier than that, to be honest. Not because I suddenly made a huge amount of money overnight, but because I